Gem International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Bob Hoye. He's a market historian who's also the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, Jim, good to be with you.
Well, some interesting stuff from the federal government this week, including a mortgage stress test that will pretend overnight rates in Canada went up 2.5%, 3%. Can you pay a mortgage at 4.5% instead of just 2 and a bit?
Right.
What's that going to do to the real estate market?
Well, it's an interesting conjecture, but what it prompts me to do is think about what if market rates of interest go up, and that then would push the mortgage side of the spectrum up in yield. And if you are enjoying a nice low-yield mortgage that's not locked in for a few years, you're going to get hammered. I mean, decades ago, I remember in England, all mortgages were tied to a current market rate of interest. And so when you were in a period of rising rates, mortgages were recalculated almost monthly, I think it was. So the prospect of rising interest rates would be, if it happened, it would be very disruptive. And as a matter of fact, this is what is possible. Right sort of at the 1st of July, the speculation in long-dated treasuries in the U.S. and long-dated Canada's really became intense, and it registered upside exhaustions and our sequential sells and things like that. So we took it as being not just a tradable top in the bond market, but quite likely a major top. I mean, huge. And the market has since sold off at its worst, I think about 10 points, which is really quite something, and then bounced. But there's nothing that changed my mind on it. I think that as determined by the U.S. Treasury market, it's in a downtrend for price and uptrend for yield. And then, of course, the market all went herring off into low-grade stuff, junk, and excessive technical things on the way up here. So we think that the market for all debt instruments is very close to a serious rise in yields. And then the other one that has been reflective of the party has been narrowing credit spreads. And, they have come in. Of course, I'm going to back up here for a moment and note that last summer, when crude oil started heading south seriously, it took the junk bond market with it, right on down to a panic in January, February, and the spread treasuries against CCC-rated bonds, which is junk, got up to, it was around 20.5%. And then more recently here, it's down into 11, well, let's call it 11.5%. And for the last few months, we've been looking for a momentum excess on this, on downside. So the RSI we thought could get into 25 was at least the target, and I think it's now around, well, it's moved overnight, and I haven't calculated it, but it's about 24, I guess. So this is in the territory where this narrowing of spreads coming down is now excessive, and within a week or so could turn and start to widen. And then the other one in the credit markets is the yield curve, which is the difference between long-dated and short-dated instruments and treasuries, and it is again now moving adversely to a party in the financial markets. So you got that, plus the gold-silver ratio in this week has broken out, and we like to call the gold-silver ratio the metallic credit spread, because in good times it comes down, and that was earlier in the year at 65, and now it's broken above 72, and it goes up, and sometimes in anticipation of problems in the financial markets, or often just closely timed to it. So what we see here are developing items that are flagging that the party is being close to ending, and then following that, the realization around, and this, credit markets are global. We use the U.S. because it's the big market, but if you have widening credit spreads, when they turn, maybe in a week or so, that's going to be around the world. Credit spreads will widen. So the idea of a national central bank doing what it wants to do, separate from what's happening in the rest of the world, of course, has always been absurd. But the interesting thing is central banks never seem to reflect on their own absurdity. They don't have the ability of self-criticism. So going back to the well, you mentioned the article about rising mortgage rates, I think it's highly probable. And if you're not locked in, you're going to find some discomfort.
Would that be the advice? Have instead of a variable rate mortgage, lock her in now?
Oh yeah, I think so. Yeah, for whatever, I don't know, 4 years anyways. Gives yourself some, you're not going to be hit by adverse market forces. That you might get hit by falling prices, but that's another story. So
we'll have more with Bob Hoye right after the break.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, the price of oil went over $50 this past week. It's down a bit today. What's your feeling on oil?
Yeah, we've had some very good trades out of oil the last few years. They panicked down to 26 earlier in the year. Obviously very oversold. Also, we had a target for the seasonal low in, late December, January, somewhere in there. And that season comes around every year, doesn't it? So anyways, the latest rally is, we can often get seasonal firming in crude prices late September into early October, and this we've had. But it's right up to previous rally at around 50. So there's some technical resistance there. And then also the previous high, I think, was 51.5. So, there would be serious resistance. And so I keep thinking here the last week or so, let's be prudent and focus on the probability of a seasonal low down into December, January. And if you look at the chart, that's often there. So, and all you need to have is kind of some exuberance in here, which we have. You've got stories about OPEC and Russia talking about cutting their production rates, hoping to get a higher price. But that's rather foolhardy, because if you sell less at a higher price, hey, you're not getting any money, enough money. And many of the countries like Saudi they've been spending the money like crazy and borrowing, so it's no longer the lush cash cow it used to be. So I think it's just going to be like the 1930s depression with grain farmers, that you had weak prices, so that you had to grow more of it. And the saying there was you were planting from fence post to fence post. And this is what you've got here, is that you will be, the oil producers will be producing as best they can. Fields that are no longer competitive will be shut down, but then with the U.S. Technical innovation with fracking, it's an impossible situation. It goes up a little and suddenly there's more production available. So oil has fallen into a new regime. We used that a couple of years ago as natural gas would be the guide, where it used to, on hot markets, get up to 12 or 15, and then it falls all the way down to 2, and then trades off of that, up to 4 or whatever. So natural gas fell into a new price regime, and you would expect the same thing for crude oil production, which it has. But if you take a look at the oil stocks this year, crude set its high in end of June, and then has been trading down and trying to match the price now, but nonetheless, whereas the oil stocks, XLE in the States, continue to go, and then now they're just testing the high of a few weeks ago. So again, there is investors out there who still want to wager money that at least conflict will drive the price of crude up. So they're paying up for oil stocks against hoping for a disaster in the Middle East, when the whole game has changed. It's just not that way anymore. Crude oil is becoming just another commodity. Copper, coal. Hey, what's the difference? So this is actually very good for markets to have a less rigged commodity, and it can go quite a bit lower. I think who knows? Just a guess. It could go back down to maybe 30 or something like that in around January. So, of course, would be a depressant on other industrial commodities. And I think on the next slide in crude oil prices, you're not going to get economists at the big houses or at governments coming out and saying, oh, this is good because gasoline prices come down and that'll put more money in the hands of the consumer and the consumer will consume. But that was not the case on the first break in crude oil and gasoline prices. These notions really don't work out. All I know is that you look back at history, and a period of weak commodity prices is usually associated with a very weak economy and unpleasant employment numbers. So we'll see what happens on that one there, Jim. Yeah.
Bob, what explains the sudden drop in the price of gold, and it's gone below the $1,300 mark?
Yeah, oh boy, the gold party this year has been really good, outstanding. Even base metal prices were base metal stocks way outperformed the metal prices, but it's been a good party in base and precious metal mining, and quite straightforwardly, it just got overdone. We had upside exhaustions on the gold stocks, along with sequential sells, and I think that was around early July. And the advice was that this would be a significant correction once it started. And then once it broke, then Ross was able to come out with a target of around, let's say, 20% plus decline in the senior gold stocks to be accomplished by late September, early October, where we are now, and which percent decline has been essentially met. We can get a bounce out of here in the gold stocks. We could also get stability in gold prices in U.S. dollars. There's we have some different forces going on here, because if credit spreads widen and interest rates go up, stock markets are going to sell off. And then part of that would be the U.S. dollar going up. So I'm accepting that there's going to be a liquidity crisis, in which case the serious money goes into the most liquid items, and the most liquid items are gold and short-term instruments in U.S. dollars. U.S. dollar still happens to be the senior currency. So you're going to have a bid for gold, and you're going to have a bid for the dollar. So how far is gold going to rally in U.S. dollar terms if the U.S. dollar is firming? I don't think so far. So, but in other currencies, which then may be weakening relative to the U.S., gold's going to look good. So, for my own purposes, I would watch for gold stocks to put in a base, get sorted out, and then that would be the way to position it. And this is not to deny that everyone should have some gold in their portfolio as kind of insurance type of thing, but you don't really look at it if you're in U.S. dollar terms for making money. It's insurance. So I like gold in that regard. Also like gold. At some point, the folks are going to look at the idiocy of central banking and realize, the next recession, they're going to take a look and say, look, at trillions of dollars of our tax money have been on the line because a bunch of experts in central banking think that they could manage the economy. Another recession says that they can't. And they're going to take away the privilege of currency depreciation from central bankers. So the public will reform central banking, though economists, most of them, are supportive of central banking. And where they depart from this a little is they may criticize a central banker for not doing enough or perhaps doing too much. And that's then not criticizing the central bank, it's criticizing the operator. But what is really needed is a full criticism of interventionist central banking, and I believe that'll come. And I think it'll resolve itself back to the ancient tradition of money being a unit of savings, a unit of account, and the only way you can force that is by having gold standard, where people can choose to transact in like currency, banknotes, stuff like that, or go to the central bank and have your notes redeemed for that amount of gold. It's a wonderful system, and when it worked for 150 years in England, it was superb at rationing credit, monitoring things, and keeping governments from getting too ambitious. But what you have here now is that the interventionist economists boast that they can manage the economy, and to do that they have to have a free hand with the currency. But the whole point of, let me go one more step, that of course this has been corrupted by such that the government or the central bank really is providing unlimited funds for an experiment in unlimited government. So the whole point of a gold convertible currency is to manage the ambition of government. It puts a lid on what central bankers can do, then that puts a lid on what bureaucrats can do. It's Jim, I could get excited about it. It's wonderful.
What is the possibility the government might come in and swoop up your gold like they did back in the 30s in the U.S.?
I think not. There's let's call it a popular uprising. That's around the world. England, Brexit, getting out of that bureaucratic nightmare. Other things are happening. Whether you agree with Trump or not in the U.S., it's a popular uprising that looks at the excesses of government, looks at how well the governing classes are living, and then looks and says, hey, how much of this is getting down to me? So, and it ends up with really what it is in your face and in your wallet government. They tell you what to do and then take your money for the privilege of that. So the last time this happened was in Eastern Europe in the late 80s, where they looked at the apparat checks and nomenclature, or whatever they called them in Russia, and looked at the promises, looked at how well they were living, looked at how poor the general people were doing, and the popular uprising was successful. It pushed communists out for a while, and the symbol was bringing down the Berlin Wall. And they took on a murderous police state. Now in the U.S., with its popular uprising, all that Washington and the whole apparatus of government, mainstream media all they have is propaganda. There's no way they're going to use tanks and machine guns on the people. As a matter of fact, liberals detest guns, so they're not going to use them on ordinary people. But at any rate, it's very exciting times, and popular uprisings have happened throughout all the history. I've read them all the way back to dynastic changes in ancient Europe, Egypt, 4,000 years ago. And this is what's going on. It is a popular uprising. Trump, I don't see as a threat. The real threat is the continuation of interventionist and authoritarian government. And sure, Trump's rough in style, but I'll tell you, half the action here in politics in the U.S. is that what he is suggesting, limits to government, is very offensive. He's also suggesting that the government act on its own laws, particularly on immigration. Legal immigration is fine, illegal not. So it's going to be an interesting struggle.
Bob, before we go, we do have a question from Belgium from our favorite listener in Europe. Mr. Frank de Beer has a great question. A post-bubble contraction should be good for gold and silver as the real price of gold goes up in the contraction, and we talked about that already. But how do you feel about farmland as a hedge? He said, is this asset class in the same bubble territory as financial assets in real estate, or do you see farmland as a safe asset that will protect you from the widespread defaults that will go along with severe contractions in global banking, especially in Europe? He said, recently, global farmland values seem to stay strong even in the face of severe soft commodities declines. So how does one safely protect yourself from the widespread and unpredictable EU bank failures?
Hey, what a good question. Farmland values. There's an index in the U.S., I think from about 1910 through to the 1940s that's reasonably reliable. And, of course, with that depression, you had a markdown in farmland prices. Now, and then another one that I stumbled on, this was ages ago, was in England, farmland values. And there was a global bubble rose and blew out in 1873. And then at that time, England was the premier economy and also the senior currency with sterling. And this index fell from about 58, just trying to recall the number, down to probably 30. That depression lasted from 1873 to 1895. And farmland values, I think, also I recall the chart, there was no year where they went sideways. It was just every year marked down. So where the price of farmland was high with the booms, there was a commodity boom in the 1860s, and then it ended and it shifted over, and then you had a financial boom, which ended in 1873, then the typical long contraction. So no, I don't see any safe harbor in farmland values. They got exceptionally high in the U.S. a few years ago, but I haven't looked at a chart on it for a bit. But they were coming down. If you had, like, the commodity index for grains coming from 570 in 2011 down here to now around 300, farmers are not making all that money out of market prices, and who knows what they're making out of subsidies from the government. But I would think that there's no safe haven in farmland in a long post-bubble contraction. So, but thanks for the question.
The land may not be all that safe, but you'll still have some chickens and cows to eat if everything else goes sideways. Bob, I hope you've hunted down your turkey for Thanksgiving.
Yeah, that's underway, and I'm looking forward to it, and I hope you're and set up the same way.
Well, traditionally we have sushi.
Well, that's all right. You take your choices, and that's what you have. So,
but their gravy sucks.
Okay.
But apart from that, sushi's pretty good. Bob, have a great Thanksgiving. My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. You can forward questions like Frank does from Belgium to info@HowStreet.com. I'm Jim Goddard. Happy Thanksgiving.
And the best.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.